Here's how it started. It's 2012. A 25-year-old named Maya opens her first investment account with just $50. She doesn't know what a PE ratio is. She's never heard of asset allocation. All she knows is she's tired of watching her savings go nowhere in a 0.01% interest account. So, she buys her first ETF. Fast forward a decade later, Maya isn't rich, but she owns a six-figure portfolio. No lucky stock picks, no crypto windfalls, just a boring, consistent investing plan. One that started with almost nothing. So the real question is, how do you actually get started like Maya? Because today, anyone with a smartphone and $5 can technically become an investor. But not everyone does. Why? To understand why most people never take the first step, we have to break down what really matters when you're just starting out. Let's be honest, investing feels complicated on purpose. Wall Street has spent decades wrapping it in jargon. Dividend yield, price-to-book ratio, forward guidance. It's designed to make you feel like an outsider, unless you've got a CFA next to your name. But the truth is, most successful investors don't rely on complex tools or day trading. They follow a plan, stay consistent, and avoid emotional mistakes. And it all begins with a simple question. What are you investing for? Because without a clear goal, it's like trying to build a house with no blueprint. And once you define your goal, whether it's buying a home, retiring early, or just beating inflation, that goal will quietly shape every decision you make. But here's the thing most beginners miss. Some goals drive real progress. Others just give the illusion of it, and the difference isn't just what you want, but when you want it. If you're saving to buy a car in 2 years, you don't want to bet it all on a tech stock that could drop 30% next quarter. That's a short-term goal, and short-term money needs to be safe. Think high-yield savings accounts, money market funds, or even treasury bills. But if you're investing for retirement 30 years from now, that's a different game entirely. Volatility isn't your enemy. It's the price of admission for long-term growth. This is where equities, index funds, and even real estate can shine. And there's a gray zone in the middle. 5 to 10-year goals like a home down payment or a child's early education. These call for balance. Bond funds, conservative ETFs, maybe a splash of equity exposure. Most portfolios fail not because of bad investments, but because the strategy didn't match the investment goal. So once you've got your goals set, see what comes next? Let's talk about risk tolerance. Not the textbook kind, the real kind. Imagine waking up and seeing your portfolio down 18% overnight. What's your gut reaction? If it's panic, you might be taking on too much risk. And that's okay. Risk tolerance isn't just about age. It's about behavior. Some 28-year-olds are natural risk takers. Others panic at the sight of red numbers. The worst thing you can do is invest aggressively and then bail when things get rough. That's why choosing a risk level that matches your temperament is crucial. Your goal is to build a portfolio that you can stick with, not one that looks good on paper. And if you're wondering what that actually looks like in practice, well, that brings us to the foundation of all investing. You don't just invest in a stock. You invest through an account. Roth IRA, traditional IRA, 401k, taxable brokerage. Each one has a different job. If your goal is retirement and you want tax-free withdrawals, Roth IRA. If you're getting a match from your employer, max out that 401k first. But if flexibility matters, if you might want that money in 3 years for a business idea, then a taxable brokerage account gives you access and control. The account you choose affects your tax bill, your flexibility, and your returns. It's one of the most overlooked decisions beginners make. So choose your accounts carefully. Each one should match a specific investment goal. But once the account's set up, what do you actually buy? Here's the secret most professionals won't tell you. A boring, low-cost ETF portfolio beats most active traders over time. Index funds that track the S&P 500, total market ETFs, a few bond funds to balance volatility, maybe a blue-chip stock or two. That's it. That's the core of a portfolio that can compound for decades. It's not about guessing the next big thing. It's about consistency, low fees, and not blowing up your plan. Think of your portfolio like a garden. You don't dig it up every week. You water it. You weed it. You let time do the heavy lifting. But even gardens need routine care. The best investors don't rely on willpower, they automate. Dollar cost averaging, investing a fixed amount regularly, regardless of the market, turns volatility into your ally. You buy more shares when prices are lower and fewer when prices are higher. It removes emotion from the process entirely. Apps today make this easy. Automatic transfers, rebalancing, fractional shares. You can invest weekly without even thinking about it. And the best part, this kind of automation builds wealth quietly, month by month, year by year, until one day you realize your portfolio is working harder than you are. But before you rush to get started, there's one final piece no one talks about. When not to invest. Sometimes the smartest move is to wait. If you're drowning in 20% credit card debt, the market can't save you. Pay off the debt first. The return on that is guaranteed. And if you don't have an emergency fund, 3 to 6 months of expenses, you're one job loss away from selling your stocks at the worst possible time. Your investing plan is only as strong as the foundation beneath it. No emergency fund, no insurance? Then investing should come after you stabilize. And here's the irony. By waiting, you're actually investing in your future resilience. So where does that leave us? You don't need to know everything. You don't need to time the market. You just need to begin with what you have, where you are. Define your goal. Choose your account. Build a simple portfolio. Automate it, stick with it, and adjust over time. Investing isn't about being perfect. It's about being consistent. And the sooner you start, the more time you give compound growth to work its quiet magic. Because wealth isn't built in a day, it's built daily.